All right, welcome everybody to this month's town hall meeting. This is Nima Dogbandin with Jurasi LLP. Want to welcome everybody on this meeting. So we've got a lot of really great updates from the GRC. We've been more active than we have ever been, and there are a lot of significant updates that will affect everyone out there. So this is going to be a good meeting. Kind of give everyone an idea. As you all know, these are the members of the GRC who are on the call today with us. But to give you guys an idea of the agenda that we'll go through, the first is we'll give everybody an update on the New York transfer tax issue, what we're doing about it. The next one is a big update regarding the SEC's proposed changes to what is an accredited investor. So that'll definitely affect people that are with mortgage funds or otherwise raising capital from investors, and it's pretty good news there. And then also we will discuss the Day on the Hill, which is coming up on March 19th. For those of you that were not aware of it or have not heard of this before, each year we've been going to Washington, D.C., and meeting with various senators and members of the House to discuss kind of an agenda. Last year we honed down on HMDA, and other related issues that were affecting us. And so we'll go back there and discuss kind of the talking points for this year's purposes and go into that. The last thing that we'll do today is going to be providing or seeking your feedback here. And we'll have kind of an open section where you can ask any sort of questions or provide any kind of feedback on here. So leading into New York, I know Matt is also on the line. Matt, do you want to kind of take over for a second and just talk about and just do a real quick recap of the related issue in New York for anyone that is not aware of it?
Yeah, thanks, Nima. So the issue here is that New York has the state of New York is trying to pass a bill which affects only the city of New York, and that is all 5 boroughs, for increasing dramatically the conveyance or transfer tax on properties that sell within 1 year or 2 years. It's 20%. It's a 20% additional transfer tax on all properties that are not new construction that sell within the first year, and if it's within 2 years, then it's 15%. Other than a normal transfer tax, which is between either nothing in some states or it can go up to 1% or 1.25% or something like that. This is a 20-fold increase over what's normal. And the stated purpose, well, really the bill has 2 stated purposes. One is to provide funding for their for the states and the cities' initiatives to combat or provide affordable housing and combat the rising rents. But it has also been stated to really eliminate our industry in the city of New York, because that is believed to be the cause of a majority of the increase in rents, the lack of affordability, is causing the so-called housing shortage, which of course is a real problem. But they're significantly wrong on the fact that that our industry and fix and flips in particular are causing this problem. So again, it's what this does by increasing the tax on the transfer of the real property. It disincentivizes almost all of our fix and flip transactions in the city of New York.
Thanks, Matt. And then in terms of kind of just recapping what AAPL has done and what we're currently doing, do you want to kind of give us a rundown?
Yeah, so we have, first and foremost, a petition that is available on the AAPL website. It has been circulated before in our newsletters. It's addressed in some of our publications. So I encourage you to go visit that as soon as possible if you have not already signed a petition. It basically it runs through this whole argument and is sent to the legislators in New York. Additionally, our president, Eddie Wilson, has been in contact with the governor's office to try to get this really from the top down, to get them to understand that this is a really big issue and can impact thousands of jobs and the livelihoods of many, not only in the city but outside of the city of New York. So Eddie Wilson is taking care of from the governor's office, from top down, from the bottom up. We've been reaching out to the legislators, the representatives and senators, to seek to have meetings in Albany in the upcoming weeks to discuss this. So attacking this from both fronts, from the top down, bottom up, and contacting our RIA affiliates or friends in New York City, kind of that will have the best way of kind of duplicating our efforts to make sure that everyone is on the same page and knows how impactful and problematic this legislation is.
Thanks, Matt. And Matt, just want to give you a big thank you, because you've been really at the forefront of this issue, particularly from a policy proposal side. Matt has been instrumental in terms of really providing AAPL's position and coherently stating it so that we can explain it in a way that the legislators will understand. And then in addition, AAPL has been really instrumental here as well. One of the things that they had to do was Darren Blomquist prepared all of the data that supports this as well. So basically pulling the specific New York data so that we could actually see the impact, not in general terms, but in actual terms of the actual sales prices, how much, effectively what's the flip profit that was currently attainable in New York, and how this would completely decimate any arguments. So also approaching this from a heavy data perspective as well. So it's exciting there, and I think that we should hopefully get some traction. All right, so the next thing that we're going to do here is talk about changes to the definition of what is an accredited investor. On the line here, we've got both Olivia and Kevin. Kevin's a partner here at Gerasi, and Olivia is an attorney here at Gerasi. They're both on our corporate and securities team, and so they've been really monitoring this on behalf of AAPL. So Kevin or Olivia, why don't you kind of give us a rundown of kind of highlights what's happening right now, what's the SEC proposing?
Does everyone hear me?
Yes, go ahead, Kevin.
Okay, and Olivia's on the line as well, right?
Yep.
All right, guys. So, as some of you may know, the SEC kind of finally realized the error of their ways and are starting to proposing to expand the definition of what's accredited investor. It's very material to a lot of us who are raising capital in the market, because the regulations we're relying upon are dependent upon what is an accredited investor, because that's who we're primarily targeting. And the goal of this is to basically broaden the spectrum based off of certain qualifications beyond just income or net worth. And so the proposed, I guess, modifications are just so broad right now. So we're going to talk about some of the big ticket items. Olivia, why don't you give them kind of the specific breakdown, and then I'm going to get into kind of where we stand on this and how we want to move forward on this.
Sounds good. Well, hi, everybody. I'm going to talk a little bit about more of the details. As Kevin mentioned, right now what the SEC has proposed is pretty vague and high level. They've asked a lot more questions than they've provided answers, but from what we've been able to glean, it seems like there are two categories of new accredited investor possibilities, and one is for natural persons and the other is for entities. So for individuals, there is an opportunity to use a professional certification or designation to be an accredited investor. As most of you know, right now it's completely monetary based, so income or net worth. So this would allow for somebody with a certain degree or license to become an accredited investor. So right now, the approval process for this is getting a commission order from the SEC, which, as you can probably imagine, would be a long and arduous process. But it would even be followed with a public comment period. So because of this process that they're considering, they've said that there will be immediate approval for certain designations. So right now they've suggested that if you've passed the Series 7, 65, or 82, you would automatically be approved to fall under this professional certification or designation category. However, if you have a different type of degree or licensure that you believe qualifies you to be an accredited investor, you would have to go through this approval process. So the SEC has mentioned they're considering CPAs, MBAs, attorneys, the list goes on and on, but they have kind of requested comment on this particular area. Does the public believe that each of these designations should warrant accredited investor status? And should there be some sort of follow-up to that as well? Should good status need to be maintained? Should active participation in licensure or whatnot have to be proven for a certain amount of time? Another category of natural persons that they're suggesting is knowledgeable employees of private funds. There's a little bit less information regarding this piece of information here, but they have said that this will basically include any employee of a private fund that's not in a secretarial or administrative role. And finally, the last category we're seeing is more focused on this idea of joint net worth. So they're including spousal equivalents in the definition to calculate what joint net worth would be. So this would include cohabitants occupying a relationship generally equivalent to that of a spouse. So that's another category they've asked for more feedback on. Currently, to calculate joint net worth, they're proposing that the securities need not be purchased jointly. So that's kind of a high level of the new categories of natural persons. Regarding entities, the SEC has suggested that registered investment advisors, LLCs with over $5 million in assets, family offices with at least $5 million in assets under management should also be automatically qualified as accredited investors. They've also built in what we're kind of calling a catch-all provision. So this would be any entity that's not formed for the specific purpose of acquiring the securities that are being offered, but they own their own investments in excess of $5 million. So that would automatically garner accredited investor status. Now, finally, as we mentioned a little bit before, currently most of what will qualify one as an accredited investor is based upon net worth, income, etc. And so one of the things that the SEC is asking is whether that there should be some sort of indexing or some sort of change in the financial thresholds that take into account inflation or other changes in geographic area and things of that nature. And again, in this scenario, I will say that there were far more questions than answers from the SEC as well. And so since the SEC has provided this vague skeleton and has requested a great deal of comments, we're working on our own letter here to send to the SEC, and I'll turn it back over to Kevin to tell you a little bit more what we're working towards and looking for with that.
Yeah. All right, guys, so kind of talking about our approach on this, at least our position, and we definitely want to be, I guess, deferential to the association's position. We can, we can help guide that as well. So the position that we're taking is essentially, we don't want an overcomplication to the verification process because they're not proposing changing the regulation that require that 506C, which would require verification of accredited investor status. So we look with that in light. We don't want to have so much oversight from the SEC to the extent that they have to verify things themselves. So one of the things that they proposed was, a lot of these education-based kind of methods to qualify would they suggested maybe some kind of approval or examination by the commission. We're against that. So the broad strokes. First thing on the Series 7. 6582, you pass the exam, you should be able to qualify. The commission's position on that was pretty clear. If they are looking for more specifics in the comment period, we would like the positions, you've passed the exam and it's in good standing because the examination can just be taken and not ever be used or ever actually be operated with, and that's easy to verify on finrabrokercheck.com. When it comes to the knowledgeable employees, our position is going to be support that position, but also beyond just the fund's employees, which in our world, funds don't have employees, talking about the fund's management company and its investment company, so its agents' employees are also eligible. And then also when it comes to the education aspect of things, this is the kind of the hairier one. because of the difficulty when it comes to verification. So our position is going to be, number one, when it comes to CPAs and attorneys, we feel that there should not be any kind of way to verify. There's no way to verify whether an attorney has been a securities attorney for X number of years objectively, and to have the commission get involved in that would just be completely inefficient. So our position that we're going to take is we're going to support that CPAs and attorneys and CFAs who have been in practice for a certain number of years, which is verifiable by any type of online verification, should be sufficient to qualify. And if you can pass the bar exam, if you can pass the CFA exam, or you can pass the CPA exam, you're pretty sophisticated as it is. Plus verifying a number of years experience should be enough, and it's objective, verifiable, not too difficult. We also support the position that MBAs should also be eligible for this, but not all MBAs are created equal. So MBAs from a nationally accredited, university is something we're gonna support in our position. And one of the things that we want to stress to the commission is that we do not want to have any type of verification process that requires the commission to be petitioned for verification of an investor. It does not bode well for private investments that require some speed and efficiency. So that's kind of the position that we want to take. I'm seeing some questions in the panel here, so we can talk about that. But this is what's going on our end. But this is where we're standing. We finished a kind of asking for questions and participation from the association and other members and our clients and so on. We would like to know what the association's position wants to be on this as well, if it diverges from ours, so we can craft that on behalf of the association as counsel in our support letter, or if it lines up with ours as well. Olivia, what's the timeline that we want to follow to get these comment letters out to the SEC?
So we have to send our comment letter to the SEC by the end of next week. So if it would be possible, if you have any comments you'd like to share, we would need them by the end of this week to properly incorporate them into our comment letter.
Right. And we do plan to send one on behalf of the association as well. So we're going to have one as a law firm and one also on behalf of the association. They can be the same position. They can be a little bit different. We're not opposed to that, because the association has a broader interest in mind than maybe the law firm does. And so happy to make those, statements to the commission. And this is kind of round one, guys. This is the first phase in all this, and it'll evolve into a narrower set of rules, which will be commented on further. So.
Fantastic. I appreciate that, Kevin, and thank you, Olivia, as well. So the next thing that we're going to cover here today is going to be the Day on the Hill. So to catch everybody up, last year we had a really successful Day on the Hill in which we really recognized the lack of information and knowledge that your typical congressman or woman has regarding the private lending industry. There was really an ultimate sense that they were not particularly knowledgeable about our industry. And so from that Day on the Hill, we sent a position paper asking for specific action to be taken. So one of the things that we asked for in the position paper last year was modifications to HMDA, particularly either exempting business purpose loans altogether, or applying the same increased threshold that was being provided to credit unions for relief, which was 500 transactions in the 2 preceding years rather than 25 transactions. So we were trying to approach from either angle, but again, ideally exempting business purpose loans, as it doesn't appear that this was who the regulators were trying to cover in this in this world. So that's one of the things that we will be readdressing again this year and pushing for momentum on that side of it. Another one is a much broader agenda, but would have an enormous impact on our industry, which is actually creating additional language to SAFE Act, so specifically exempting from licensing requirements business purpose loans, and thereby creating a federal preemption that would prohibit a legislative bodies from requiring a mortgage loan originator license to originate a business purpose loan. So that could have a really significant impact nationwide, and that's something that we'll be positioning for this year. Kevin and Olivia went into lengths about the SEC proposed changes, and so really AAPL is there to support any proposed changes that would loosen up the capital markets. And then lastly, discussing changes or specifically bankruptcy reform issues related to business purpose loans. So creating a dual track process or a streamlined process, because bankruptcy rules are typically designed to protect individual consumers, and they should definitely be afforded rights and significant due process in bankruptcy. However, as most people on this call would note, is when they are used in the business purpose context, they are usually just simply a delay tactic and something that doesn't seem to really bear any rational relationship to protections that should be there. So a discussion regarding potential bankruptcy reform related issues, and that'll form our agenda for March 19th, and we'll obviously be following up with everybody and letting you know the results of that, but want to let you know what the association is planning on doing. And so with that, we'll just move to our kind of last stage of today's agenda, which is any sort of feedback. We've got a couple questions in the hopper here that I'm happy to address, but this would be a great opportunity for those who have not already submitted any questions. There's a little chat function that you should be able to insert any sort of questions on your end, and we're definitely happy to address them. The very first question that was asked was regarding the New York State transfer tax issue. Do we have a concern about whether other states are going to adopt this form of regulation? And yes, that's actually one of so not only are we obviously concerned about the impact in New York City and the fact that this would effectively just eliminate all flips in the state, but in addition to that is will other state legislative bodies look to this as a way to deal with an affordable housing crisis and try to implement similar limitations? So by way of example, actually, Kat was able to find a proposed piece of legislation in Oregon, which is much more moderated and much smaller, but kind of similar issue, which is a nominal transfer tax based on the sales price. This one is over $500,000 for Oregon's purposes, and less than 1%. But nonetheless, clearly state legislative bodies are looking at transfer taxes right now as a way to increase revenue, and also what they tend to be doing when they're looking at this is that the revenue will then go into some sort of affordable housing budget or fund. And if California is an example where we have designated these sorts of funds before, they created an affordable housing fund which created per unit prices of $550,000 of production. So a pretty failed experiment here, and so obviously we're not particularly keen on letting other states test this experiment at the expense of basically crushing the flip market. So we're definitely concerned, and that's I think why the association is as active as it is, even though this is a very state-specific issue. The national implications of New York passing this are significant nationwide. The next question that we are seeing here is, how can we get access to the data and materials given to the legislators? Great question. So, in terms of we can focus on the New York related issue. If you go to AAPL's website, which is aaplonline.com, if you go to the website, there are tons of great links on there, but there's one for the GRC, and you'll find the related issues for New York City on there. So there's position papers on there as kind of details on how this tax works. I know in either this issue of the magazine, I think that's where you'll find Darren Blomquist's article related to the data behind New York. So and Kat, just let me know that the link that you'll want to go to for this is aaplonline.com/gov, G-O-V. So that's where you'll find information on this. The next question we got on here was a person who was in New York, and they're in contact with people in New York, and they want to make sure that they've got material they can provide as well. So how can you assist? So my recommendation, and Kat, feel free to jump in on here as well, is for anyone that wants to participate, particularly for people in the New York audience, we have a petition, but for those that want to get more actively involved as well, particularly if we can schedule meetings in New York, is there a best next step from your perspective, Kat?
Yes, when we have the New York meeting set up in Albany, we will be reaching out to our members who are located in New York to see if they want to participate in those meetings. And until then, what we're really finding, and when we've been in contact with these legislators, is that any petition that we might have, when you're filling that out, if you can go into more detail about how this affects you and the story that you have as far as how it's going to change your business and, in all cases pretty much hurt your business, then that's going to have a lot of impact too. So even if you can't make it to that meeting, being able to sign that petition and have that heard is going to be helpful too. The other thing that you can do is that if you go to aaplonline.com/gov, on the more information page about this particular issue, you're going to see we've written a letter that you can then use on your own and download as a Microsoft Word document if you want to send it as snail mail or as an email. We've also provided contact pages to different bill sponsors and important people on the committee that currently has this. And so you can send that, fill that template letter out according to how it affects your business personally, and then send that into as part of a contact campaign. So they're hearing personally from many different people beyond just signatures and information on a petition too. So those are some of the best ways you can get involved. And then just keep looking at your emails, especially our newsletter that goes out for more information on an upcoming trip to Albany.
Appreciate that, Ken. One note on that as well is one of the things that we've seen with great success is the more the phones ring, the greater the voice is heard. So oftentimes these pieces of legislation are passed in isolation without necessarily understanding the unintended or intended consequences. And so to the degree that there's a significant backlash, particularly from a phone volume perspective, that it definitely gets the legislators' attention. And as it pertains to the people involved in this, if you do go to aaplonline.com/gov and locate the New York specific side of this, they list on there every single senator's office and contact information. So would highly recommend, particularly for our members in the state of New York, to start picking up the phone, as the phone may be the most powerful instrument you've got here.
We have another question that just came in from one of our attendees that I wanted to say out loud just because I can't type it into the chat window fast enough. Under the SEC proposed guidelines, I myself would not qualify as an accredited investor. With that, it is a dream of mine to be able to provide investment alternatives like this to investors who don't fit the current guidelines. I would like to elaborate more, but essentially it is my belief if investors can qualify or have a 30-year mortgage for a rental property, that individual should have the right to access these types of investments. Essentially, if investors are smart enough to get a mortgage, they should not have the right to access funds and or investments in this industry. Thank you for that comment, Brian.
Yeah, that's a great point. I'll probably kick it over to Kevin or Olivia on this. I know you had discussed extending the definition out to certain professional designations. Is there any sort of, I don't know if there's been any kind of thought process on extending it out to people who have demonstrated an investment history. So, for example, purchase of rental properties or otherwise. I don't know if there's any kind of thought process on that.
Fortunately, the SEC's position on this has really been, they have toyed with the idea of portfolio size or a certain level of sophistication based off of examination. You can kind of get the sense of that in the proposed regs, but the commission's approach on this is very pragmatic, and my understanding is they have been given suggestions to broaden, but I think we have to understand from a foundational perspective is that the reason why this accredited investor concept actually exists is because this is what allows us to offer securities without registration or SEC, what you call kind of regulation over or review of the offering materials. And so for those of you who are aware of the Regulation A process, that's a much more in-depth, essentially public offering. So this allows us to stay out of their crosshairs because we're selling primarily to very high net worth people that the SEC believes can absorb risk, can ascertain risk, and who don't necessarily need to be protected. And so for that reason, it does not make practical sense from my perspective that the commission would open it up beyond people who they believe can understand, absorb, and take on risk. And I think that they'd be very wary to go beyond a threshold as low as a certain owning a certain amount of investment properties, but your net worth isn't a certain amount. The net worth requirement is very impactful if you think about how it impacts actual investors' balance sheet. But I don't foresee the SEC ever lowering the standard beyond what they've done or what they've posed already, just because I think that would open the door to arguments against these exemptions, and now all of a sudden the SEC may insert itself beyond what they're doing right now with these Regulation D offerings, and that's one thing we don't want, right? We want them to be able to offer securities as an exempt position without SEC review of the offering documents. So.
Appreciate that. Any more further comments or anything, Kathy, you're seeing on this side?
We had another comment from Brian saying, yes, but there is a certain criteria that needs to be met. It is not going to be that simple, but just because people aren't rich doesn't mean you aren't smart enough to understand investments in this industry.
No, that's very true. That's very true. I agree with that. It's just unfortunately we have to have you have to have a standard which is regulatable and also objective that we can follow predictably from a legal standpoint, and so that's kind of the world we live in, right? So
we have another question that came in from Patrick, or statement unrelated to the New York issues. I would very much like AAPL to lobby against tax lien lending. I believe this is only legal in Texas and Florida and perhaps Nevada, but we need your help. Tax lien loans are extremely dangerous for us private lenders. Tax lien lenders can come in and take priority lien with extremely low risk. For example, they will take superior lien on the property that we already have first lien on for, say, $500,000 for whatever is owed in property taxes. That could be $5,000, for example. This is outrageous. Why is this not illegal in all states? We, Texas, Florida, and Nevada lenders are at an extreme disadvantage in this situation.
Sure. Yeah, that's an interesting position. I mean, so most states, at least as far as I'm aware of, will provide a super priority for property taxes. So the failure to pay property taxes is a super priority against any lender's lien. And most states have a pretty well-defined body of law that provides for redemptions or otherwise, even if there is an accidental lapse where a property tax lien occurs. And a lot of states have really interesting regimes on that. So, for example, some states will even let private individuals purchase a property tax lien. So there's a lot of really interesting play there. I think most states have some form of super priority as it relates to property taxes. And I don't think that you would have a lot of momentum in changing something like that. But there are interesting issues. So, for example, the state of Nevada has a super priority based on their association. So an association lien can jump and get a super priority over a lender's lien, and that has been litigated for many, many years and continues to be litigated. I mean, the good news is that private lenders are not alone in this fight. So, every national bank is also fighting tooth and nail on an issue like that. So far, without particularly great results, the Nevada legislature has not been willing to change the law pertaining to that, the super priority for associations. the interesting thing is that it appears to be something that is a very odd law to have on the books, and it wasn't really a law in the first place. It was really just a lack of clarification on what the law stated about priorities. But that said, certain states have weird rules, but related to property taxes specifically, like I said, I think most states have some form of super priority on that issue, and I don't know if there's going to be an easy way to change that or lobby against something like that.
Patrick does have a follow-up comment. He says, yes, the state can have super priority for property taxes, but the problem is when there are private tax lien lenders who are lending to the individual who owes the property taxes with complete disregard to the terms of the first lien that we as the private lender may have.
Yeah, it's an interesting point. I mean, we're happy to look into it, and I love that kind of feedback. So I'm not aware of call it a personal tax issue, but that would be interesting to look into to see which states have. So, for example, I know in California there's no super priority provided to any sort of franchise tax board lien that the state of California could create. That would be whenever they record the lien is the position it would come in. But yeah, there may be states in which there are potentially super priorities provided on this on the state taxing side of it, and that's definitely something I think that the GRC would be interested in trying to oppose, and be interested in trying to make momentum happen on that side, because it is definitely a problem. Anything else on the horizon there, Kat?
Not yet, no.
Well, fantastic. Yeah. Fantastic. Well, I appreciate that. And yeah, I appreciate everyone's time here on the call today. Really appreciate the GRC committee. As many of you may or may not know, we meet with a lot of frequency. So it's the most committed team I have seen, and people are putting in significant personal time, energy, and effort by researching their own jurisdictions, by maintaining a database of senators that are related and other legislative bodies and contacts for them. So it's really been it's impressive to work along with colleagues on the rest of the committee. So even though they haven't been vocal on this call today, I do really want to thank my fellow committee members, because they have just been instrumental in putting so much passion and heart into pushing these issues to the forefront. So just a quick thank you to them, and thank you for everyone on the call here today as well.